This presentation focuses on understanding financial statements and has been specifically designed for non-financial managers. Our goal is to familiarize you with the basic financial statements and how these can assist you to make better business decisions. We will cover 3 of the 4 basic financial statements: the balance sheet, the income statement, and the statement of cash flows. The 4th statement, called Statement of Capital or Statement of Stockholders' Equity, is rarely used by non-financial managers. Therefore, we will focus on those financial statements that you may actually use in a business setting. Financial statements are used by many individuals in different roles. External users may include shareholders, customers, government agencies, lenders, suppliers, and the community at large. Internal users, management and employees, are those individuals who have the responsibility for managing and running the business. Though each type of user has different information needs, they seek answers to 3 basic questions. Can I get paid? If you are a lender, a government agency, a supplier, or a community organization, you will be particularly interested in the response to this question. A company that shows a profit but has no cash cannot pay its bills, make charitable donations, or provide economic compensation for wrongdoings. Another key question, particularly if you are a customer or an employee, is this company financially stable? From a customer perspective, you want to be sure that the company will be around in the long run to support its products or services. As an employee, you want to ensure that your income and your job are not at risk due to economic difficulties. The 3rd question, should I invest or continue to invest in this company, relates to the utilization of capital. A rational investor will move funds to those companies that can provide the highest return on their investment, either through the payment of dividends, the appreciation of the stock price, or the company valuation. Let us start with the balance sheet. The balance sheet is like a photograph. It captures a picture of the financial condition of your company at a fixed point in time. It shows the economic resources of the organization and all the external and internal claims against these resources as of a particular date, for example, December 31st. A balance sheet is also known as a statement of financial position, and in banking it is called a statement of condition. In the heading, the balance sheet shows the date of the financial statement, in this example, December 31st. The balance sheet consists of 3 principal elements: assets, liabilities, and equity. Assets are the economic resources of the organization, such as cash, receivables, inventory, property, and equipment. Liabilities are the obligations to third parties, such as government agencies, suppliers, and lenders, among others. Stockholders' or owner's equity is the money that has been invested or reinvested by the owners in the business. It also represents the internal claims of the owners against the assets or economic resources of the organization. It is the difference between assets and liabilities. The basic accounting equation which underlies the balance sheet states that assets must equal liabilities plus owners' or stockholders' equity. In other words, the economic resources of the organization must equal the claims against these resources. Let us illustrate with an example how the accounting equation works. Suppose a company has assets of $100,000 and liabilities of $60,000. Stockholders' equity, represented by X, is unknown. By manipulating algebraically the basic accounting equation, we can determine that stockholders' equity equals assets less liabilities, or in this example, $40,000. The basic accounting equation shows the relationship among assets, liabilities, and stockholders' equity. It is an important rule which governs all accounting systems. In contrast to the balance sheet, the income statement is analogous to a video. It measures the financial performance of the organization over a specific time period. The income statement is also known by several names, such as Statement of Operations, Statement of Earnings, Profit and Loss Statement, or just plain P&L. In the heading, the income statement shows the period covered by the report, for example, for the year ended December 31st. The income statement details the revenues earned, the expenses incurred, and the net income or profit for the period. Revenue or sales is the first major category found on the income statement. It represents the income that flows into the business as a result of services rendered or goods sold by the firm. Revenues are eventually converted into cash. Expenses are located immediately below the revenue section. Expenses are the cost of goods and services consumed in the course of generating revenues. The salaries and fringe benefits of your employees, utilities, and rent are some common examples of expenses. As shown in our example, expenses are often summarized by functional area, such as sales and marketing, general and administrative expense, and research and development. Expenses are generally paid with cash. The difference between revenue and expenses is net income, which represents the net amount earned during the period. Let us illustrate how this formula works with a simple example. Suppose a company has revenues of $500,000 and expenses of $350,000. Using the formula shown above, the net income would equal $150,000. Net income is transferred to equity at the end of the accounting period on the balance sheet. The last statement we will cover in this presentation is the statement of cash flows. This statement details the sources and uses of cash and provides a user with information on the cash position of the company and why it changed from one period to another. The cash flow statement is divided into three major sections, which represent the major activities of any organization. The first section is operating activities. Operating activities relate to the primary business operations and usually involve the delivery of goods or services. This section will provide you with an indication of how much cash is being generated from the company's main business. The next section shows the cash generated from investing activities. These activities include all transactions that relate to investing in the business, such as lending money, collecting on loans, acquiring and selling investments, and acquiring and selling property or equipment. The last section shows the cash generated from financing activities. This section includes all transactions that involve how the business finances its operations, including the proceeds of stock and debt issues, repayment of loans, and dividends. Finally, I would like to talk briefly about the importance of the notes. The notes are an integral part of the financial statements. They contain information that is essential in order to fully understand the financial condition of a company. The first note will always present a summary of significant accounting policies. You may want to skim over this section to understand how the company is recording common business transactions such as revenue, inventory, and the purchases of property and equipment. While the notes can get very technical, there are several notes that non-financial users should look for and read carefully. Contingencies or legal proceedings, off-balance sheet financing, and subsequent events. As I conclude this presentation, I would like to share some final thoughts on the use of financial statements for decision-making. Financial statements must be compared against something to provide an indicator of performance. Prior year results, industry averages, or financial information from competitors if available. Therefore, if you are using financial statements to evaluate the creditworthiness of a customer or the financial stability of a supplier, it is essential that you ask for comparative financial statements that contain at least the current and prior year results. This concludes our overview of the basic financial statements. We encourage you to view the other training videos of this series, which cover in more detail the topics presented in this video.